Let's get now to Smart Charts with Abigail Doolittle, where we look at timely topics through the charts. This week, Abigail, you are taking a look at charts that suggest the risk rally is set to continue.
Indeed, we are, Scarlett. And to do that with me is Steve Suttmeier of Bank of America Merrill Lynch. Thanks so much for joining us as always, Steve. And, it's pretty remarkable today. At the lows overnight, the S&P 500 futures down dramatically and then closing at an all-time high as it's thought that these tensions in the Middle East are de-escalating. But it seems like probably all risk is not out of the market, and yet we have this bullish reaction. And your view of your S&P 500 chart is pretty bullish.
Yeah, I mean, it's very interesting. It seems like the bulls only come out at night, right? I mean,
or bears, you mean?
I'm sorry, the bears. Thank you. So this chart of the S&P just basically shows a daily chart, 50-day moving average, and we did achieve that triangle target around 3220, which was something we talked about, I guess, the last time on the show, which is good. I like when things work. Right now, what will keep things working, in my humble opinion, is we could stay above that 3200 level on the S&P. Why is that important? It's projected support, it's a gap level, and it's a nice round number. So if we can hold that level, I think the wall of worry stays intact and the S&P can climb it.
Now, are you concerned, however, that we're maybe a little bit overextended? Because when we take a look at it relative to the 50-day, we're a bit above that. If we had the 200-day moving average, we're about 10% above that 200-day moving average. And when that has happened in the past, we've tended to see some consolidation. So what do you think about that possibility?
Well, I look at the Williams percent R, the 28-day Williams percent R, which is a chart that we show on the show also last time, and it stayed overbought, actually. And it's been overbought since December. Quite frankly, to me, as long as that's overbought, meaning above negative 20 on the Williams percent R, I think we grind higher. And if you hold 3,200, I think we could see 3,300s, maybe even by the end of the month. It's quite possible. So I'm bullish above 3,200.
And not surprisingly, with this bullish chart and the bullish action on the day, volatility very low, very suppressed. Some saying there's complacency, but you think that volatility suggests more gains could be ahead.
Yeah, I mean, this particular chart is the 3-month VIX relative to the VIX. So while the VIX index itself is showing reduced volatility on the day, I'm a little bit concerned actually about this ratio. Why? Because it's showing a bearish divergence. It's showing that actually the relative trend of this chart is actually showing that we're actually getting a little less complacent because those overbought readings are complacent. So under the surface, there might be something going on based on this term structure ratio of volatility. So is it going to be like a 2018 event, or is it going to be like an early 2017 event? Because remember, we did have those divergences back then as well. I'm inclined to think it's going to be more like 2017. Why? We were in a trading range for 2 years. We broke out above that range, and that projects much higher. In fact, if you take the breakout from the range that we're in, that broadening top that everybody was so nervous about last year, looks like a head and shoulders continuation. And if that breakout meets its target, we could see 3850 on the S&P over time.
Before we take a look at your high yield chart, is there any chance that that's a false initial reaction out of that broadening formation, or you think it's good to go?
For me, when I look at the past cycles, if we hold the breakout point around 3,000, we're good to go.
So supporting your bullish view, high yield. Let's take a look at a high yield chart, because talk about investors seeking yield right here.
Yes, the high yield market and the investment grade market, very important charts for me. I use these a lot, and we talked about this on the show before. Remember, we're not getting the bearish divergences that we saw at this peak, or even even coming into these corrective phases. We got new highs on the high yield index, which is this line right here, and the IG index up there, new highs. So what that tells me is there's no real stress in the market, and dips should be limited. I get more worried when you start to see stresses build up in the market, meaning that high yield spreads start blowing out, the BAA to Treasury spread starts blowing out, and they're going to new cycle lows here.
And I remember that you made the point that around the Q4 2018 sell-off, ahead of that high yield had already started to sell off. So we're certainly not seeing that now, perhaps supporting your view that maybe just a little bit of consolidation similar to 2017.